2018 question 3. So there is no one on physical class. I will depend on you on the answers. So kindly, mkwe mkinisaidia. Be of help. So I'm already there. The question says, and I read, Mercy, Nelly, and Onyango are in partnership, sharing profits and losses equally after allowing for interest on capital at the rate of 5% per annum to the partners and a salary to Nelly of shilling 60,000 per annum per month. The trial balance of the partnership as at 30th September 2018 was as follows. So we have sales, inventory, purchases, operating expenses, loan from Nelly and Onyango, land, building, plant, accumulated depreciation, accounts receivable and payables, bank overdraft, capital accounts, current accounts, drawings. Additional information. On 1st April 2018, the terms of the partnership agreement were changed. On 1st April, check there, 1st April 2018, the terms of the partnership were changed. The new terms provided as follows. So, in the terms, number 1, a profit sharing ratio of 5:3:1 for Mercy, Nelly, and Onyango, respectively. Salaries of shilling 30,000 per month to Nelly and Onyango. Interest on capital at the rate of 5%. For the purposes of the change, goodwill was valued at 3.6 and was to be written off immediately. Hapa wasiposema, goodwill, make sure you write it off. You share them, you write it off. While land and buildings were revalued at 6 million and 19.2 million, respectively. Sales include a credit sale of 1.8 in respect of goods sold on the basis of confirmation by the customers. The goods are cost 600. As at 30th September 2018, the customer had not confirmed whether he would buy the goods. So wewe ulisikia tu itanunuliwa na wewe ukainvoice. Customer hajachukua, itabidi umetoa kwa sales. Interest on loan from Nelly and Onyango is to be charged at the rate of 10%. This interest has not been paid. Closing inventory was valued at 7.2. Unless where otherwise provided, the income and expenses accrued evenly throughout the year. Evenly means uniformly, proportionately, equally. So that one means you will time a portion, we'll check the period, then we'll time a portion. Required income and appropriation for the year ended this 8 months, partners' current accounts, then statement of financial position. So now, please, the first thing to do, when you are required to prepare, the P&L, when there is admission, retirement, or change in policy, like this one is a change in policy, check the period. When did that thing happen? So check the year end, hapo kwa required. The year is ending on 30th September 2018. So you check it this way, like this. So it ends on 30th September 2018. So for it to end on 30th September 2018, check tomorrow of this one here. Angalia kesho. So tomorrow of this is 1st October, then you backdate. So 1st October 2017. That is when the year starts. So can you check in which month In which month did they change the policy? Because I want to go and separate the profit account. So when did they separate the policy? Did they change the policy? So note number one, on 1st April 2018, 1st April is somewhere here. That is when they changed the policy. So we'll prepare two profit accounts before change and after change. So tell me, before change is how many months? So check the months. Na hapo kwa months unakuwa makini usikose hata kidogo. Seven. I highly doubt. Yes, it is 6. This is 6. Hizo months usikose hata kidogo because unaenda miss the entire question. You be very keen. So it is 6 months, 6 months. So it means you will have the two P&L for 6 months, 6 months. And something else I thought of that we should do first to avoid a lot of stories ahead there. Let's prepare partners' current accounts. Sorry, partners' capital accounts, because after the change, interest on capital will be based on the new capital balances. Will be based on the new capital balances. So I want us to come up with partners' capital accounts so that when we are in the P&L, we want interest. Before the change, we take the balances brought down. After the change, we go for the new figures. So can you have, as a form of working, partners' capital accounts? So we have Marcinelli Onyango. Shillings are in thousands. So Balance brought down. Balance brought down. Check the capital balances at the beginning. At the beginning, capital account. Check the line again. It is 75.6. It is 76 or
75.
it is 75, yeah? So this is 75. The one we given is 6, 3. Then there was goodwill. Goodwill, they say, not one, bullet 1, 2, 3, 4. Bullet 4, not 1. For the purposes of the change, goodwill was valued at 3.6 and was to be written off. So goodwill, you share in the old ratio first to their capital account. So the old ratio, before they changed, the old ratio was, check where the question started. Mercy, Nelly, and Onyango are in partnership, sharing profits and losses equally. So divide that one by 3 of them. Divide by 3 comes to, it is 12.
Yes.
I give us prayer. Then you write it off. So goodwill written off. Goodwill written off. You cannot write off in the using this ratio. You will have done 0 work. So write off in the new ratio. So new ratio, check note 1. After the changes, 5 is to 3 is to 2. So can you share for P36 in that ratio? Then tell me the answer. How much? I can see 1800, right? 18, 1080, then 720. Very good. Then again, for the purposes of the change, they revalued some assets. So check bullet 4 note 1. Bullet 4 note 1, for the purposes of the change, goodwill was valued to 3.6 and was written off. We have done that. Land and buildings were valued at 6 and 19.2 respectively. So can you go to the balance sheet? Go to the balance sheet. Let's have balance sheet. Land. There's something I want you to do for me because it can also be required. Niandikie hapo revaluation account. Revaluation account. Do that. Have revaluation account. So revaluation account, it records the increase or decrease in the value of the assets. So like land, so when the asset increases, of course you debit the asset. When asset goes up, you debit, then you credit this account. While a decrease you credit the asset, then you debit. So let's start with land. Land was revalued to 3 points. Land was revalued to 6 million. In the trial balance, land was 3. I hope you can be able to see that. Land was 3. So it means there was a revaluation gain of 3 million. So the 3 increased land account, then credit revaluation. So land 6 minus 3, that is 3,000. That is 3,000. Then buildings, book value was 15. It has been revalued to 19,200. That is also an increase. So buildings 19,200 minus 19,200 minus 15,000. That is 40 what? 42. So the total revaluation gain is 7,200. So this 72 you share to the partners. So you say here to capital accounts, Mercy, Nelly, Onyango. Share to them equally. So it is 72 equally is divided by 3. How much? How much per person?
2,400.
2,400. Yes. So you go to their capital account and credit their capital with that revaluation. So you go to capital, then you credit here with revaluation gain. Revaluation gain 24, 24, 24. Question. So can you give me the balance in figures? So balance carried down. Give me the balances carried down. So give me the balances carried down. Give me the balances. So Esther, can someone confirm the answers? You have the same answers, Navera, so that is okay. 93, 85, 20, then 58, 80. 58, 80. Therefore, why was I interested in preparing this account even before doing anything? Whenever there is a change in partnership, capital will change. So before the change, interest is based on this opening, these funds. After the change, the interest will be based on the new capitals. That's why yesterday you saw us preparing this before finishing the P&L. So even now, I want to do it right here now. You say interest on capital, interest on capital. Interest on capital before change. Before change is based on the balance brought down. So you consider the balance brought down. So before the change, you base it on the balances brought down, even before retirement, before admission. So you base it on these balances. So what was the interest on capital? Check where the question started. What was the interest on capital? Interest on capital, which you can be able to see was, what percentage are you seeing? Interest on partners' capital?
5%.
5%. So, Masinelli Onyango, you take 5% of the opening balances, this and that. So 75, 6, 3. But remember, 5% was per annum. So you multiply by 6 over 12. Give me those answers. Someone with answers?
$187.5.
187.5.
150.
150.
75.
25.
75.
75. And let's do after. After change. After change, you base it on the balance carried down. So balance is carried down at these ones. Oh, after change, what was the interest policy? Still 5%. Check bullet 3 of note 1. Also 6 months.
It's 10%.
No? Check bullet 1, 2, 3. Bullet 3 of additional information, not 1.
Okay.
All right, give me the figures.
So 32.5.
So we have 232.5,
213,
213.
147.
Good. Good. All right. So now we can start. We can start now the presentation of P&L, unless there is somebody with a question here. So if no question, then let's start presentation. You write there, Mercy, Nelly, and Onyango. So the year ended
30th.
30th September 2018. So you estimate you will bring the first 6 months before change. Then you bring total. So shillings are 1,000, so you split them each corner. So have that. So we can kick off. So I told you yesterday, and I will still remind you, you capture up to the gross profit. Your portion then should start from the gross profit. So you start with sales. So sales in this question was 60, but there was a problem. There is kuna customer alikuwa ameuziwa, check note 2. Check additional information number 2. Sales include a credit sale of 1.8 in respect of goods sold on the basis of confirmation by customer. The goods are cost 6, fine. The customer had not confirmed whether he would buy the goods. So subtract. Customer does not know that story. So 1.8. Remove the selling price. So what remains? There is no sale there. The customer has not picked the goods, so stop disturbing us. So how much? 60 minus
5,200.
What?
5,258.
58. 58. 200. Yes. Less cost of sales. Opening inventory. Opening inventory. We have 9. Add purchases. Purchases 3,900. Closing inventory. So closing inventory, note number 4, 72. So give me the cost of sales.
$700.
So how much is the 32,700? So gross profits. Gross profit is how much?
$25,500.
25,500. So apportion this. So in this question, they never brought any issues that, what. They said, check note 5, additional number 5. They said unless where otherwise provided, the income and expenses accrued evenly. Evenly means uniformly. So you time a portion, 6 months, 6 months. 6 months is a half. So divide this by 2, it will be how much? 12,250. How much? Divide 25,500 by 2.
12,750.
12?
750.
750. 750 times 2 is supposed to be 500. Sure. So here, 12,750. 12,750. That is true. Now we go to less expenses. Less expenses. So can you check? Let's check from top. We'll be together. We check from top. Sales, no. Inventory, no. Purchases, no. Operating. So there is operating expenses. Total is 19,200. Divide by 2. $19,200 divided by 2. 90 what?
96.
96. Then loan. There was loan from Nelly, and this loan was attracting interest. So loan interest. The total loan is 3 plus 6. 3 plus 6. Then interest rate, check note 3. Check additional information number 3. Walipea biashara loan. Interest on the loan from Nelly Onyango is to be charged at the rate of 10%. So take 10% of this. This is 9,000. 10% of 9,000 is 900. So bring here 900. So you take 450, 450. Next, land no, building no, plant no, accumulated no, accounts no, bank overdraft no, capital no, current account no, drawings no. So we go to the additional information, we check if there is any expense we should capture. 1. On first list, the terms of the partnership agreement were changed. The new terms provided as follows. 1. Profit sharing, no problem. Salaries of 30 per month to Nelly and Onyango. Appropriation account. That will go to the appropriation account. Then we have interest on capital, no problem. For the purposes of the change goodwill, no problem. So note 1, no issue. Note 2, sales done. 3, interest on loan done. Closing inventory done, unless tuition. It's too small. So can you add? So 96 plus 450. This is 10,050. Even this one. So this one will be times 2. 20,100. So subtract to get net profit. So net profit, you take this minus this, equal. So 12,750 minus 10,050, 2,700, 2,700, 5,400. And once you have net profit, you go to appropriation accounts. Appropriation accounts. Appropriation accounts, we start with interest on capital. So interest on capital, pick these ones. We have them here. We have before and we have after. So before, this was 187.5, 150, 75. This was 232.5, 213, 147. So add them across. 187.5 plus 232.5. Here you get 420. You add 150 plus 213, 363. 75 plus 147, 222. So you add plus 363 plus 420. Here you get 1005. 232 plus 213 plus 147, 592. I will ask whether you have the same figures, so don't copy me. 187.5 plus 150 plus 75, that is 412.5. 232 plus 213, no, 232.5 plus 213 plus 147, 592.5. Please confirm whether you have the same figures. So you have the same figures? Somebody to confirm?
Yes.
So there was also partner salaries. Partners' salaries, check before the change. The first paragraph where the question started. Mercy, Nelly, Onyango are in partnership sharing profits after allowing for interest on capital done. The partners. A salary of 60. A salary to Nelly of 60 per month. So only Nelly was getting salary. Nelly Begani, only Nelly. So Nelly, Nelly was getting 60 per month, multiplied by 6 months before the change. So 60 times 6 is 360. I hope you have understood what has happened. 60 per month times 6 months, 360. Join after the change. Check note 1. Salaries of 30 per month to Nelly and Onyango. So Mercy Bado. So Nelly and Onyango, 30 per month. 30 times 6, 180. So 180, 180. 360. 540. 180. 720. Please finish yours accurately without copying me. Make sure you understand what is happening. In the first, only Nelly was getting. This one I hope you have no problem. The second phase, it is Nelly and Onyango to get 30 per month. 30 times 6 is 180. So 180, 180. Then for the total, Mercy never got anything. This is 360 plus 180 is 540. This is 180. Nothing plus 180 is 180. Then you combine them. So to confirm that we are together, can you take now this net profit minus this? Munipatizo 3 answers, multiply hapo. So this minus this one, this one, this one. Give me those 3. Then we share them as profits. Then we are done with P&L. Do for me that favor. So I've been given the answers. 1927.5. 1927.5. 1747.5. Then 3675. So down there, write profit share. Profit share. Mercy, Nelly, Nyango. So before change equally. So take this profit divided by 3. $642.5. 642.5 for everyone. You finish with nil. Nil. To the other side, 1747 divided by, no, wait. After change, the ratio changed. The ratio now is 532. 532. So share this one in the ratio of 5 is to 3 to 2. So 5 plus 3, 8 plus 2, 10. So it's 5 over 10, 3 over 10, 2 over 10, which is just 0.5, 0.3, 0.2. So 1447.5 times 0.5, 873.75. 873.75. Huyo mwingine 524. Brian is giving me the figures. 524.25. Then the other one 349.5. 349.5. You add. That is 1747.5. Nil. So what I want you to do for me, can you add for me the profit shares? This plus this, work a total evil. Please do that. Add the profit share. M before, after, before, after, before, after. So Brian umeanza na gani? Total for M 15, 16. 15, 16.25. Then for N 1166.75. Then 992. I hope if you add, you get 3675. Then you say nil. Full stop. We are done with the P&L. Nani ako na swali before I go to the second required?
Excuse me, Mwalimu. I have a question.
Yes,
What do we do with the 600,000 at the
with
note number 2? The note number 2. What do
note
we do
number
with the
two.
600,000? Yes. What do we do with the 600,000?
That 600 is quite irrelevant because you know they're just trying to confuse us. We have been given the cost and the sale value. So the sales you remove plus the profit because you know sales is profit inclusive. So you cannot come and subtract only the cost. That cost I don't see its relevance there. What to require one, two, partners current accounts. Hebu mchore partners current accounts. Balance brought down. So here you bring balance brought down. Those things you have captured in the appropriation letter. Interest on capital, partner salaries, profit share. If there is drawings, you bring them here. So balance brought down was, please, me, 696. Are those the figures?
Yes.
Interest on capital, check appropriation. You check the totals, the far end. 420, 363, 222. Partner salaries, 540, one. No, we haven't got anything. 540, 180. Profit share, those figures are about 15, 16.25, then 1166.75, then 992. Then drawings are 9, 12, 6. Give me the balance carried down. So you type for me the balances. So I've been given there, Rivera, 1636.25. Then we have 1769. Sasa hapo mmetofautiana na Esther. 1394. Can somebody confirm, Nelly? Naona 1769 and 1768. Which is which? Someone to confirm for Nelly?
1768.
So Vera, you may confirm.
1768.75.
So then we go to the statement of financial position.
Mwalimu, it's 69, not 68.
Means you use me mkono calculator. Esther confirm, people are saying 69. Esther confirm, Miss Yaman.
Seventeen 68.
So wacha nitakuja kuadd. I gave you time to consent, so Esther amekubali 69. Thank you. So let's go to the statement of financial position. So where's my duster? So andika hiyo majina yao, statement of financial position. So non-current assets. Non-current assets. So we go for land. Land was revalued. Once an asset has been revalued, you take the revalued amount. So land was revalued to 6. 6. Buildings were also revalued. Buildings were also revalued to 19,200. Then plant and machinery. Plant and machinery, you will take the cost, which is 21, minus the accumulated depreciation. Accumulated depreciation, 12. That is 9. Add for me the total.
Thirty-four 200.
30.
34 200.
34,200. Current assets. About current assets, receivables, tuletea shida. So inventory, take the closing. Inventory. Inventory. Closing inventory. Note number 4. Note number 4, it was 72. Receivables. Receivables. Receivables ndio 50-50. There was that which they said hawakuchukua. So I want to subtract that 1,800. So when you subtract that, what do you get? 10,200. Huh?
Yes.
Yes.
Then 200. Then there is bank overdraft. Bank overdraft will go down there. Then there is nothing. This is 17,400. So total assets. Total assets is how much?
51,600.
600. Capital and liabilities. So bring for me capital account, those balances need to be part plus the current account. 1 minute.
Nitakuwekea sahii tu nikimaliza, si ndio? Nitakuwekea, acha tu hapa nakuwekea sahii sana. Unatumia hii? Darling, pa ulikuwa unataka earpod? Sawa.
So capital and liabilities. Capital accounts. Hapo mtaitabidi mnisaidie. The balance is carried down, I don't have them. Can you list them, please, in that order?
9,300.
Yeah.
9,300.
9,300.
85,20.
85,20.
58,80.
58,80. Total?
23,700.
23.
Yes.
Current accounts. Current accounts. This one's here. Pick these figures. This current down.
1636.25.
Yes, sasa hizo niko nazo. So just add for me. So
4800.
1636.25, 1769.75, 1394. When you add,
4800.
eh?
4800.
4800.5, huh?
100 hivyo tu.
Okay. And you add the two?
Twenty-eight 500.
Yes?
28,500.
28,500. Now current liabilities, there was loan from partners. 3 plus 6. It was 9,000. Partners gave this business some loan. 9. I want to change the camera. Current liabilities, payables. Payables. Payables we have 9,900. Bank overdraft. Bank overdraft is 33. Then read note number 3. Check additional information number 3. Check additional information number 3. Additional information number 3 says interest on the loan is 10%. This interest has not been paid. So accrued loan interest accrued loan interest 10% of 9,000. It had not been paid, so it is 900. Can you add the 3? This plus this plus this.
14,100.
Yeah?
14,100.
14,100. Total capital and liabilities.
$51,600.
It is the same. Yes.
Yes.
Correct. So don't log out. There's something I want to tell you. So now, you can get a question. You can get a question where the change, retirement or admission has taken place at the end of the year. So if that is the case, you don't apportion. Unaweza hapo ushtuke hii tuliambiwa kama ni P&L na kuna admission or retirement we are supposed to apportion. Then you find it was at the end. So if it's at the end of the year, there is nothing you are apportioning. There will be no problem. So that is one. Two, we don't have time to do retirement. Retirement is exactly the same with what we have done. It is the opposite of just admission. The partners, all of them will be for the interest before, then after we are equal. Then we get up a balance sheet, even balance sheet, you drop the name of the person who has left. So kama ni Mercy Mary Anyango left, unabaki na Mercy and Mary. So retirement is just the same thing. There is nothing which changes. So that is perfect. If they bring partnership, kindly work on it. You have seen how it is done. Now, write for me there, statement of cash flow. Statement of cash flow. So right now, there is a handout for public sector. I'm sharing with you before I leave. That is one. Two, I'm sharing with you the notes on cash flow. You write them, then we discuss in the next class and we do a question. So make sure you write those notes. So we'll discuss in the next class on Wednesday, we do a question. Saturday, we do another question. Then we see what will happen. Otherwise, thank you so much.
I have a question.
Brian, yes?
Let's assume we were told that the drawings accumulated an interest. Where do we factor that interest on drawing? That the drawings accumulated an interest. Where do we factor that?
That one I've explained so many times. Maybe you have never been keen. Interest on drawings, you add it back. About appropriation account. In the appropriation, you add it back to the net profit. You know, drawings is the money they have taken for their personal use. So tunasema wewe ukichukua pesa unarudisha na interest. So interest on drawings you add back when you are preparing appropriation, add it back to net profit. Then when you go to partner's current account, you debit partner's current account with that value. Brian, is that okay?
Yes.
Very good. So I'm sharing with you the handout for public sector. Hiyo usome na usome vizuri swali linatokanga hapo. Then I'm giving you the notes for cash flow. Muandike yote. Then we discuss in our next class on Wednesday. Then we do a question. Thank you. Continue enjoying your weekend.